Welcome to The Explainer. Today we're diving into the incredible story of the Terra/Luna crypto collapse. It's a wild ride through brilliant code, some serious arrogance, and a financial explosion that it evaporated tens of billions of dollars in a matter of days.
Okay, let's start here, because this quote really nails it. Think about it for a second. We can send an email, a photo, pretty much anything, to the other side of the planet instantly and for free. But sending money, that's still slow, it's clunky, and it's expensive. And for the tech crowd, for the geeks, that's not just an annoying problem, it's a challenge that they feel has to be solved with better code.
So you know the big knock on cryptocurrencies like Bitcoin, right? The prices are just all over the place. I mean, you can't really use it to buy a coffee if it might be worth 20% less by the time you finish drinking it. So, to solve this, the market came up with something called stablecoins. The whole idea was to create a digital dollar that would always be worth, $1.
Now, most stablecoins keep their value in a pretty straightforward way. They're backed by real stuff. For every digital coin, there's a real dollar in a bank account, or some gold in a vault, or a bunch of other cryptos held in reserve. Simple. But as you can see right there, Terra USD, or UST, decided to just throw that whole playbook out the window. It was an algorithmic stablecoin. It was a radical, high-stakes bet that a clever piece of code could be just as solid as cold, hard cash.
Right. So this is the key. There were no dollars in a bank backing up Terra USD. Its entire value, its entire promise of being worth $1, was held up by a computer program working in tandem with a sister currency called Luna. The whole system, the whole shebang, it wasn't built on collateral, it was built on the absolute belief that the code was perfect.
So how is this money machine supposed to work? Well, the design was actually pretty brilliant. It was a self-correcting system that was powered by one of the most reliable forces on Earth, people trying to make a quick, easy profit.
The core idea was super elegant. I want you to picture a seesaw. On one side, you have UST, and on the other, you have Luna. The algorithm's only job was to keep that seesaw perfectly balanced so that UST was always worth $1. So if the price of UST ever tipped up, even to say $1.01, traders were given an incentive, a small risk-free profit, to create more UST, which would push the price back down. And if it dipped below $1, they were paid to do the opposite. It was supposed to be this perfect self-healing loop, all driven by arbitrage.
Okay, so that's a clever balancing act, for sure. But you still need people to actually want to buy and hold your stablecoin in the first place, right? And Terra? Oh, they had a reason. They had an incredibly powerful one.
And there it is. That was the hook. 20% annual return. I mean, it was just an unbelievable number. You could take your Terra USD, deposit it into a lending platform they built called Anchor Protocol, and earn a yield that was basically unheard of anywhere in the traditional financial world. And this offer, this magnet, it pulled in billions and billions of dollars, making the whole Terra ecosystem just explode in popularity.
But here's the fatal flaw, right? The whole system, including that insane 20% yield, depended on constant growth and absolute confidence. That money wasn't coming from thin air. It was being paid out of a reserve fund that was bleeding cash. And in May of 2022, that confidence just shattered, and the whole thing went into a death spiral.
The speed of the collapse was just breathtaking. You can see it on the timeline here. It was a classic bank run, but on crypto steroids. A couple of big players pulled their money out, which triggered a wave of panic. And suddenly, UST started to slip from its $1 peg. The algorithm, that balancing act, it tried to kick in, but the panic was just too big, too fast. In less than a week, a $60 billion financial ecosystem was just gone.
So as everyone was stampeding for the exits, selling their UST, the algorithm went into absolute overdrive trying to defend that $1 price. It started printing billions, then trillions of new Luna tokens to try and prop things up. But all that did was flood the market and make the price of Luna completely worthless. The very mechanism that was designed to create stability became the engine of its own destruction.
And the end result was just devastating. We're talking about regular people, folks who were lured in by that promise of a 20% return, many of whom put their life savings into this thing. They lost everything. The total losses are estimated in the tens of billions of dollars.
And the shockwaves didn't stop with Terra. This wasn't an isolated event. The collapse created this massive crisis of confidence across the entire crypto world. It set off a chain reaction, a contagion, that wiped out an estimated $500 billion in value across the whole sector. It was a true systemic shock.
So you have to ask, how could something built by incredibly smart people fail so completely, so spectacularly? Well, the answer isn't just in the lines of code, it's in the culture. It's about a kind of technological hubris, a powerful belief that brilliant innovation can somehow let you sidestep the old, boring rules of finance.
And this, right here, illustrates that mindset perfectly. There was this deep, almost religious conviction that if your algorithm was elegant enough, if your code was smart enough, you could finally tame the chaos of human markets. They really believed they had built something that was above the normal human patterns of fear and greed.
So you see, this wasn't just a technical problem. It was a massive psychological failure. You had this perfect storm brewing, this euphoria about new tech, a massive fear of missing out on getting rich, and an online echo chamber where anyone who raised a red flag was immediately shot down. Investors didn't just ignore the warning signs. They actively sought out reasons to believe, because they wanted it to be real.
So, after the crash, after the dust settled, the big question became, who's to blame? Was this just a tragic accident, a good idea that failed, or was this a massive intentional fraud from the beginning?
At first glance, it really does look like a classic pyramid scheme, right? But here's where it gets really, really tricky from a legal perspective. When you compare it to a straightforward fraud case, you see these key differences. Terra's code was open for anyone to see. The system was decentralized, and there wasn't one single company controlling all the money. All of that makes it incredibly hard to prosecute as simple fraud.
And here is the core legal challenge. To prove fraud, a prosecutor can't just show that the system was a bad idea or that it was super risky. They have to prove that the creators intended for it to fail from the very start, with the specific goal of tricking people out of their money. Proving someone was reckless or way too optimistic is not the same thing as proving they had criminal intent.
And this might just be the biggest legal hurdle of them all. In a lot of places around the world, the law still hasn't decided on a fundamental question. Are cryptocurrencies legally property? And if the answer is no, then you can't be charged with a crime against property, like fraud. It's this giant legal gray area, a loophole created because the technology is moving so much faster than the law can keep up.
Which brings us to our final and maybe most important question. As governments everywhere race to write new rules for crypto, they're running headfirst into this fundamental challenge. How do you regulate a system that's designed to have no one in charge? And when the code breaks and everything falls apart, who exactly do you hold responsible in a world that's run by a decentralized algorithm?